This is Adam Laibson. Welcome to the Mainsail Financial Group podcast series, where we get a chance to host industry experts and local professionals to talk about their areas of expertise and provide some guidance into different areas that we don't normally talk about or focus on a day-to-day basis. So today we're changing things up. In fact, you probably noticed two major changes right away. The first one is that we are in fact practicing our correct social distancing, and we're working remotely. And the second thing is that the interviewer is now the interviewee. We get a chance to interview our very own Brandon Steele and thank him for being part of the podcast today, and just get his thoughts about the financial world that we see ourselves in today. With all the market changes, with all of the uncertainty, believe it or not, we had new tax laws, we had a Secure Act, we had a CARES Act, a lot of things happening since the beginning of the year. And so today we thought we'd get Brandon's thoughts and expertise on what's important and what to pay attention to. So again, you've probably seen Brandon before as doing the interviewing. He's a CFP, he's a co-owner and partner with Mainsail Financial Group, working in the financial services industry since 2011 as a financial planner, and always had a strong focus on relationships and building long-term planning and really being part of the process of becoming trusted advisors for all of our clients going forward. So did I miss anything, or does that pretty well cover it?
I think that covers it. It's
Okay.
interesting kind of flipping the tables here, but excited to dig in a bit today.
Absolutely. Perfect. Well, there's been so much change lately. We just wanted to make sure that we really give people a chance to hear directly from you about some of your observations and thoughts about what's going on. So as I mentioned before, a lot of change in general since the beginning of the year. But what are some of the things that you're watching right now and paying close attention to?
It's a lot. To your point, there's been a lot of change this year for sure. Right now we're in the midst of the coronavirus concerns, and I think we're kind of dealing with unprecedented times in a lot of different areas. So, obviously the virus is a big thing that we're watching, updates on health and, how that's spreading or hopefully slowing at this time. The impacts of the markets. And then also, to your point, there's been a lot of tax changes between the Secure Act that passed January 1st, and then also the CARES Act that just went into effect here a couple of weeks ago.
Mm-hmm. So maybe let's take each one of those in a little more detail. So when the Secure Act passed, what were some of the things that people should be aware of?
Yeah, good question. So there's a couple things that are probably the top, I guess, most relevant pieces through that. Number one, we talk a lot with our clients about required minimum distributions. And for the folks listening, maybe you've heard of this, maybe you haven't. The acronym for it is RMDs. But believe it or not, because you are getting tax benefits in your pre-tax 401ks as you're working and saving, before this went into effect, the IRS made you take money out at age 70 and a half. So, the whole idea is obviously you're deferring taxes while you're working, but the idea being that, they're going to want their taxes at some point. So one of the big changes was that got deferred. So instead of 70 and a half, you're now able to kind of defer some of that taxation or distribution till age 72. Year and a half, I think people are probably going big deal, but it does create some opportunities. If Roth conversions make sense, if some ways to spread that out make sense, you've got a little more time to maybe get some of those things in place.
Wonderful.
I think the second thing, maybe the biggest thing, is the way that accounts are handled when they pass to the next generation. So prior to this new change in the Secure Act, whenever retirement accounts were passed to your beneficiaries, to kids, let's say, next generation, right? Not necessarily side to side, but as soon as we go down, they would have to take money out just like you would have had to after age 70 and a half. The difference is that before this, they could stretch that out based on their life. So especially if they were younger when that happened, they may not need to take out all that much. But as you know, Adam, that's changed significantly. Now, they've got to take all that money out within a 10-year period. So just to kind of give an example, right, if you have $1 million in a 401k and that goes to your kids, they can either take it out all in one lump sum, $1 million in year one, or stretch it out, let's say $100,000 a year, but it must be depleted after that 10-year period.
Interesting. Could they wait to the last possible moment, like the last month of the last year, and take a full distribution then?
They could, yeah. And it's interesting you say that, because that's one of the things I've been thinking about is, okay, so who's tracking that, right? Because with this change, that's a big thing to miss, especially if you try and defer it all the way to the last year, because the penalty is just like it was before. You got to pay 50%, 50,
Mm,
on the amount you don't take out. So
that's
that's going to be
insane.
interesting to see how that pans out over the years coming up.
Absolutely. Absolutely. And what's interesting is that the CARES Act just passed. It was put in effect January 1. And then here we are 3 months later, and we have another act that's just passed just within the last couple of weeks called the CARES Act. Can you share a little bit about how that's important when it comes to planning, or what the relevant pieces of that are?
Yeah, absolutely. And I'll preface by saying I'm still learning a little bit of the ins and outs. This is really new. But part of it is, as business owners, you have an opportunity to apply for a loan for wages that you may be paying. So from what I understand, basically, if you have employees, as long as you maintain or grow your workforce during this period, you can apply for a loan that will be forgiven, through all of this turmoil, I guess, that we're in. Another part of it, based on income, is that you may also be receiving a stimulus check from the government here as well. The idea is, obviously, this is a really tricky time in the economy, and so hopefully that will spur a little bit of economic activity and kind of keep things alive to some degree.
Mm-hmm.
But I would say the most important part, the part that we have been kind of addressing most from a planning perspective, is in regards to that RMD that we talked about just a minute ago. So normally, if you were over 70 and a half or 72 this year, you would have to start taking money out of your accounts. They're actually letting that slide for the year 2020. So in other words, let's say you needed to take, I don't know, $20,000 out of your accounts this year. That is not a requirement. You can still take those distributions if you need them, but you're not forced to do them this year.
Interesting. So what about the folks that have already taken some RMD distributions in the first part of the year before all of this happened? What are they able to give it back, or what happens to that?
Yeah, that's a really good question. A lot of folks are in that boat because they may take it out right when they start. Not to get too far into the weeds, but there is a rule where you can put it back in within a 60-day period. And I'll kind of leave it really high level like that, but as long as it's within the past 60 days, you can, put that back in and basically act as if nothing happened, if that makes sense.
Absolutely. Okay, perfect. Very good. Very good. This year it's interesting. I think one of the big lessons just in the first few months of the year is that things can change on a dime, right? Just when things are heading in one direction, something can come up, and now we have to zag where we used to zig. So my question for you, Brandon, is how can people set up strategies that allow them for the ability to get ready or prepare for these changes, or even to course correct when the winds shift?
Yeah, I think that's the question on everyone's mind right now, right? There's been, just in the last month, there's been so much change with the markets alone, with the CARES Act. So this year's just been a whirlwind. I think the first thing is to take out emotions in your planning strategies. I think that a lot of folks will have biases in what they think may happen. And so a lot of the planning that we do gets kind of wrapped up in that. If we think, just for an example, if we think taxes may be higher in the future, we may position our planning strategies around that. If we think they'll be lower, we may position them the other way around. So I think that is really key, is to kind of take out emotions. And then from there, making sure that you're setting up multiple paths, right? Everyone knows how important it is to diversify your investments, but what I think gets missed a lot is the importance of diversifying your planning strategies, the higher level stuff. If all we do is head down one path for retirement, for savings, for taxes, for all that good stuff, what we find is, if the landscape kind of shifts when we get there, we may be kind of caught, I guess, caught with an unexpected consequence. Let me put it that way.
Sure.
Right.
Sure.
So I think a big key to that is to say, okay, how do we maybe create multiple paths so that whatever the world might throw at us, we can take advantage or kind of zig and zag to, make the most of the landscape at that point.
Got it. Well, that makes sense. Yeah, absolutely. Absolutely. We hear in the news quite a bit when they report on how the market's doing, they talk in broad strokes that people should be doing this and people should be doing that. But what are some of the things that folks should consider from a planning perspective that really aren't discussed in the media and just sort of in general? What are some things that we can be looking at, or planning strategies we can be looking at that aren't talked about quite as often in the media?
Yeah, I think so. I think there's kind of two levels to that. So I'll kind of break it down. I think one is on the investment front, and the other might be on the bigger picture, the planning stuff that we've been talking about. On the investment front, I think the key is the importance of understanding how to structure a portfolio for the long term. So, I think that one of the key factors is that the way that we look at it is to develop this to really win the war as the starting point. So in other words, if we're setting up for retirement 20 years down the road, that may dictate our asset mix, our stocks and bonds, if you want to put it that way, right? But along the way, there are battles that happen every quarter, every day right now, it seems like, but every quarter, every month, every year, right? And so I think a big part that sometimes isn't addressed in media or through, a lot of what you read and from a generalized standpoint is how to use those two together. You want to set up your portfolio to win the war and not deviate too much, but it's important to also make some slight adjustments over time to kind of take advantage of opportunities that are out there, or in this case, avoid some potential risks that might be out there. Mm-hmm. And that way you kind of smooth the ride out, hopefully also do a little better, but smooth the ride out to some degree as well.
Gotcha. That makes good sense. I do have one sort of last question, last topic to kind of bring up. One of the things that's happened as a consequence of the economic landscape that we're in right now is that interest rates have been lowered and lowered and lowered, and now we find them to be at some of the lowest points they've ever been. So with interest rates being this low, how can people manage risk when bonds just aren't looking very attractive these days, right?
Yep, I think that's really fair. What's that?
I just want to know what your thoughts were on that.
Yeah, I think that's a huge question right now, because obviously bonds are supposed to be our conservative or safe part of the portfolio too, right? Mm-hmm. So I think maybe to step back a little bit, I want to maybe share, I know you know this, but share a little bit with the audience on how bonds work from a high level. Sure. And then we can kind of dig in. So, you guys may understand this as well, but bonds are obviously an issuance of debt, right? And so when you buy bonds, really what you're doing is loaning a state, municipality, a government, whatever the case might be, you're loaning them money, right? So let's say you give them $1,000 today. The idea is that, let's say 10 years from now, they'll pay you your $1,000 back. But what do you expect for that in the meantime, right? What do you expect for that for holding off for 10 years? Interest, right? Mm-hmm. And so let's say that entity gives you 4% interest every year. So $1,000 in, 4% every year, like clockwork, and then $1,000 on the way out. So the challenge is when interest rates are as low as they are today, potentially only one way to go, although I might have said that a ways back too, but they just kept going lower. Anyways, if they do go up, think about it this way, right? If you're holding a machine that's paying you 4% every single year like clockwork, and now interest rates have bumped up, and that same machine is now paying 6%. How do you feel if you're holding the one paying 4%? Probably not so great, yeah. Right? So, and the reason why is because obviously there's something bigger, faster, stronger out there, right? So if you were to go try and sell that 4% machine, do you think you're going to make more or less for that?
I would assume probably a little bit, less?
Yep, absolutely, right. I know you know this stuff.
You're discuss. Yeah,
you're obviously going to make a little less, because why would somebody give you $1,000 for a 4% machine when they could give somebody else $1,000 for a 6% machine, right? So I think that's really key, is to understand how that works mechanically, and really understand that as interest rates go up, bond prices actually drop. So one of the ways to kind of help manage through that, to get back to your question, is if you think about a bond as like a teeter-totter or like a seesaw, right? Mm-hmm. The longer that plank is, the more wild those swings are going to be, right? But if you're able to shorten that plank, let's say instead of 10 years to 3 years, I'm just giving examples, sure. That's going to shorten or dampen those swings quite a bit. So that's one of the things that we look at. It's also important, anytime you're talking about debt, obviously one of the risks is default or credit risk.
Mm-hmm.
So obviously you need to, kind of take that into account as well. But just generally speaking, by shortening that plank, it really can help manage some of that volatility.
I understand. So maybe looking at duration more than what percentage of your portfolio is bonds might be one consideration.
Yeah, absolutely. Yeah, I think now more than ever, to your point, it's extremely important to understand what you actually hold,
Mm-hmm.
right?
Sure. That
Not
makes
just
good
that
sense.
I own bonds, but what do you actually own within those bonds?
Right. What does that mean exactly? Very good.
Yep,
Very good.
absolutely.
Good. Well, I think that's a good place to kind of wrap things up. Again, we just wanted to get your thoughts on a couple of high-level topics. Certainly, these are some very volatile times, as I mentioned at the beginning. Any last thoughts or comments? Anything else you'd like to share?
No, I mean, I think one thing just to kind of add in something for timely advice, I guess, through all this is, we are going through a really tough time right now. No question about it. And there's so much uncertainty. So I think as folks figure out how to really develop strategies through this, there's really three things that you need to address. And number one is you need to prepare, you need to manage your emotions, and then you need to act on your plan. So, if you think while you're in the middle of this, it can be very difficult to think clear-headed, right? We can get really emotional as we see these crazy swings in the market day to day. So, if you were to prepare a little bit, obviously that may mean having a strategy coming into this. Maybe that meant some diversification. Maybe that meant taking some chips off the table before all this happened. Whatever the case might be, right? You had some sort of strategy in case this came up. And now while we're in this, we can start to execute, right? We can say, okay, now that we're in what's going on, maybe things are on sale, for instance, you may want to consider when to rebalance, which basically may buy and sell some of your assets.
Mm-hmm.
But keep that plan in mind and stick to it. Now, things are changing day to day, but it's really key when all of this noise is going on to focus on the long term and know what you're aiming for and where you're headed before you just start, I guess, getting too emotional or making too many knee-jerk reaction changes to your plan.
Right. Leaping before you look.
Yes.
Essentially.
Yeah, absolutely.
Understood. And if anybody has any specific questions for you, or they'd like to talk about investing or how investing can be a piece of more comprehensive planning, how can people get a hold of you?
Yeah, you can email us info@mainsailefg.com. Again, that's info@mainsailefg.com. And of course, happy to answer any questions, whether it's about this material in particular or anything that you're experiencing through the markets right now or planning in general as well.
Wonderful. Well, Brandon, thank you so much for your time this afternoon. Greatly appreciate it. Great words of advice and guidance. And we want to thank everybody for tuning in. And we're very grateful for your ongoing support in these podcasts. And we hope that you take away something really wonderful and valuable. And we'll see you next time.
Thank you.